There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery going to be along in a moment to get us up to speed on the details from today's trade. I'm going to start with the major averages. There's enough action in the major averages alone to let's talk for a few minutes about, because we saw an enormous swing in the major averages today between the highs and the lows of the session. We came out of the gate strong. Looked like we were going to see that much awaited bounce in the markets today after some heavy selling that we've seen as of late, but it didn't last, and we saw markets fade by the end of the day. The Dow was sort of the last to give it up here today. It looks like right now it's going to end the session down more than 300 points, about 0.9%. We saw around midday the White House confirming or just reiterating that the tariffs that will be enacted and effective on China as of midnight will be 104%. The president commenting he was awaiting a phone call from China that he says has not come, even as negotiations with other countries appear to be beginning. So we saw rollover in all three major averages. The S&P down 1.5% on the day. Again, a huge range between highs and lows, a historic one even. And what's interesting is it's not just today. We have seen that range really over the past few sessions here, big daily ranges between the highs and the lows, which is quite unusual here. And then finally, I'll end on the NASDAQ. Of course, we've seen that range in the NASDAQ as well. Today, that ended with it down more than 2%. Jared, I know you've been looking at this big swing that we've been watching as well.
Yes, easy come, easy go. Looked good at the open and doesn't feel so good by the end of the day. That is the nature of a bear market. So I don't think we swung into it officially in the S&P 500, but we are very close, and it certainly feels like it. Let's check out the VIX, because I've been laser focused on that. I'll give you a year-to-date chart. You can see yesterday it opened at 60. That red bar means it's sold off, but today it is rocketed back up. That just tells me that there's a lot more institutional hedging needs and a lot of pressure on the market right now, and we don't see that subsiding anytime soon. Here's the bond market VIX. That is just skyrocketing as well. And you take a look at the 10-year T-note yield. That was first plummeting, and now it's rocketing upwards. It is up 35 basis points over the last 2 days. All of this volatility puts a lot of pressure on risk markets, meaning stocks, which is why you're seeing all this red here. So all 11 sectors are in the red today. Financials, the least bad, and the worst of them is materials, down over 3%. Then we have real estate, consumer discretionary, energy, and tech, all down more than 2%. And let's take a look at the NASDAQ 100 for a look at the mega caps. Only Broadcom in the green here. That's up 1%. Tesla down 5%. Apple also down 5%. The others a bit less. And we do see a smattering of green, so not quite as bad as some of the other days, but definitely not good. And then in the Dow, we see JP Morgan up 1%, United Health, that healthcare play up 5.6%, and a few others, but nothing to really write home about. And then we can also take a look at some of our leaders here. Aerospace and defense, I was noting this the other day. It was the last to really capitulate to the downside. It was holding up pretty well. I'll show you a year-to-date chart. Just fell off of the bridge with everything else a few days ago. That is up slightly today, so that's kind of a defensive position, interestingly. But everything, just about everything else here in the red, led down by cannabis and solar and biotech. So interesting combination right there. And on that note, I'll throw it back to you, Josh.
Thank you, Jared. For more now, we're joined by Timothy Chubb, Chief Investment Officer at Gerard. Timothy, welcome to the show. I want to get your take on the market action we saw today, Timothy. Listen, we saw it in the morning. Lots of green, right? We gave all that back and then some, Timothy. You just look at the popular averages. We finish all in the red. What do you make of today's action, and what does it tell you more broadly about the market, Tim?
Yeah, thanks for having me. Ultimately, I saw some numbers this morning, from futures, from where futures were at to where we closed out the day. I think this was the largest, move that we've seen really since 2008 in the markets, from futures to close at least. And so I'll have to confirm that. But I think as you were just, mentioning, we're seeing liquidation, and we're seeing a lot of people who had taken on a lot of risk coming out of the pandemic, a lot of retail traders, a lot of hedge funds, and candidly, people in my seat taking on a lot of risk, not understanding leverage, with all these new leverage ETFs and the like. And so it's taking some time to unwind this. And, this is still before we've even priced into a recession. I don't think we'll hear much from comments from management teams in earnings season as far as guidance is concerned. And so, that leaves us, really flying blind and trying to make estimates of where we think earnings might be for the next year. And so if we're, flat at 18 times, that's 44.50. And that's another, a 10% more to go. So we have not at it yet, just kind of sitting patiently, playing defense. That's kind of how we came into the year, and ultimately wait for all the, liquidation to get through its system.
Tim, it's Julie here. It's good to see you. What does defense look like for you? I think there's a lot of folks playing defense right now, and it has different flavors. So for you, what does it mean for you guys?
Yeah, I guess in short, it's, in a lot of ways, it's been short politician, long CEO, and looking for where leadership is. It's been, quality on the corporate side of things, and the fixed income markets, but it's also been quality within, the equity side of things too. So businesses that are going to remain resilient, that may not have the tariff related exposure on the equity side of things, and then really ratcheting back, risk as quickly as we could earlier this year on the fixed income side. And I think a lot of the selling that we've seen is this basis trade with the long end, kind of getting under control. We saw a lot of forced liquidation yesterday afternoon. And it might be an interesting buying opportunity, if ultimately the market does really come to the realization that this is a recession and we need to play, defense even further, and let's allocate to U.S. Treasuries.
I see the notes here, Tim, that your base case for the U.S. economy is a recession. I'm just curious to put more color on that. Is that shallow? Is that deep, Tim? And do you think that's already reflected in the market and earnings expectations?
I don't think that's reflected in equity markets just yet, and with earnings expectations. I mean, it was just last week, probably 10 days ago, the blended earnings estimates for this year were like 12%. Last week we saw 3. I've seen people come out with 0. But we really haven't seen I think the totality of a recession being priced in. We certainly have not seen it yet on the fixed income side of things. We're beginning to. I mean, spreads have widened out. I think the low was around 261 this year. We're out to 450 plus now. But I really think there's a lot of analogs to what we went through with the policy shock back in 1990. We had the war, an oil shock, and that really sent a vulnerable consumer and a vulnerable business community, especially on the manufacturing side, into a shallow recession. And so ultimately it took a little bit longer for the labor market to recover, but it was 8 months. And we had a wonderful 10 years, that came after that for equities and for the economy, as there's a lot of parallels between AI and the internet. It's just a question of, where's that savings and loan crisis come from? Is it private credit? Is it some other leverage in the system? I think that's really what the market has not even yet started really looking into just yet.
So let me, I guess, take the other side of that. What would salvage all of this? What would help the U.S. economy avoid a recession, in your view?
Well, I think starting with a tweet, we saw what happened yesterday when markets really reversed course on the fake news, that had come out in the morning. I don't know if it was a staffer or something that wanted to show proof of concept, but pretty unbelievable move that we saw. It's hard for me to kind of step back and expect that we won't see a recession. The wealth effect cuts both ways. And so, boomers have, really relied on their 401ks, to get into retirement and rely on them through retirement as opposed to pensions. We heard from the electorate in November that the economy and inflation is not working for them and that they're vulnerable. And we've seen a lot of, credit card delinquencies start to pick up. It is really bottom quartile consumer, just like it was in 2019. And so it gives us even more, I think, reasoning as to why this will be a shallow recession. It is, unfortunately, a very bifurcated economy, have-nots. And I think that'll likely bring us out a bit more quickly. But, we're kind of in a very different territory at this point. I mean, these tariffs haven't been imposed at these levels since 1909. I think that was the year that President Taft introduced the income tax.
Well, we'll see how that turns out, Tim. Thank you so much for joining us.
Thank you.
Coming up, why market turmoil doesn't suggest that stocks will continue to sink, but instead lead to a sucker's rally. Maybe we already saw it. I don't know. We're going to talk about it next. The S&P 500 fell more than 10% in 3 days following President Trump's quote-unquote Liberation Day tariff announcement. The decline was one of the worst stretches we've seen since World War II. For more, we're bringing in Yahoo Finance markets reporter Josh Schaefer, who has been looking at the story through the charts.
Yes, Julie. So our first chart is going to be that historical reference that you just made, right? So taking a look at some of the biggest drawdowns in history over a 3-day period. So what stands out on your screen at the top there, within the same period, but that would have been Black Monday, where the S&P 500 fell over 20% in a 3-day period. Some other key dates stand out there. You see the Great Financial Crisis, the COVID pandemic, and again, Black Monday. Then when you flip to the screen that has our recent sell-off, you can see Trump's tariffs are actually at the bottom, a 10.73% sell-off. But again, we're talking about this level of selling off being at the level of the Great Financial Crisis, the COVID pandemic, and Black Monday. These are some of the worst days in market history. So it just puts a little bit of perspective of sort of the breadth of sell-off that we're talking about. Speaking of breadth, another chart I brought here is looking at stocks trading below their 200-day moving average. So stocks that are below their average price over the last 200 days. I was looking at this with our friend Jared Blickery, and you can see how that has just tumbled, right? And I think over the past couple of days, you guys have probably had strategists say this. I've certainly had sources tell me this. You've seen sort of correlation go to 1, right? Everything's getting sold off. We're going to sell off everything and ask questions later. I think this is one of those charts that helps sort of explain that. Everything's trading below its 200-day moving average. It doesn't matter if you're Nike and you have clear exposure to tariffs, or you're another company where there isn't a lot of tariff exposure. You're just seeing a little bit of chaos right now. I'll feed my last chart with chaos. I highlighted yesterday's market action. We could also use today's market action for the examples. But right now, what you're seeing is just clearly a market that is moving on every tariff headline. And yesterday, you saw that in about a 15-minute span with an 8% swing in markets across 15 minutes. Pretty crazy.
And then today, you had another swing that was not in the same compressed time, but I think it was a 6% swing today in the S&P 500 from the highs to the lows.
So to bring up Jared Blickery, our great friend, of course, our data editor, he ran the numbers. That's 3 straight days the S&P 500 has swung about 6% or more. So that goes back to last Friday. Again, it just gives you the feeling of it's not just you're looking at crazy headlines and you feel crazy and it feels like the market's moving. It's really moving. We were up 4% at the open today, referencing the S&P 500. I think we closed down more than 2%. I mean, the swings are real right now. They're aggressive. And I do think that's why you're hearing some folks come on air and say, you know, maybe don't just jump back into this market. Maybe have a little bit more of a relaxed feeling right now.
I was going to ask you about that. As you read through the strategist notes, which I know you do dutifully, is anybody saying buy here? Is anybody saying back up the truck?
I don't think so, Josh. I think what a lot of people want to hear is a little bit more clarity on, I mean, still, we've been saying this forever, but a little bit more clarity on exactly where we're landing with tariffs here, and they want the flow of headlines to stop. Like, I think it's just a tough environment to say, back up the truck. I want to go shopping right now on some of these
fundamental issue, your point, remains policy uncertainty.
Right. And then I think Keith Lerner from Truist made a great point about this yesterday. We got earnings season coming up, right? Earnings start on Friday. And I thought Keith's point that it's not necessarily what companies say. He wants to see how stocks react to what companies say. We've had all of this selling off. We clearly have expectations that earnings won't be great and companies are going to be talking badly about tariffs. But is that priced into the market? And we're going to get a good feeling for that over the next couple of weeks as well.
Yes, it will be very educational. Thanks, Josh.
Always, Julie, always.
Appreciate it. Our next guest says market turmoil and the extremes in sentiment do not suggest that stocks will continue to sink, at least not in a straight line. They could lead to a sucker's rally where shares bounce before plunging even further. Joining us now, Spencer Jacob, the Wall Street Journal investing columnist. Spencer, I've been enjoying your columns as of late. Did we already get the sucker's bounce? Was it like earlier today and then it was gone already? Or do you think we're going to see a series of these kinds of bounces?
You know, if you're in a severe bear market, you tend to have a series of them. And today was, I think when we look back in the textbooks in 10 years or 20 years, it might be one of the classic examples because it was so sharp and so short. The bounce that we had, was really exuberant this morning. And then we just sank throughout the day. It's a really remarkable swing. They do typically last several days. I mean, during the 2008 and 2009 bear market, you had a number of them. During the tech bust, you had a number of them, some exceeding 20%, where people thought, well, this is it. We're in a new bull market. They lasted for weeks. And then we ultimately saw new lows. And that's more typical.
You know, Spencer, you write in the piece about these sentiment readings, and we were talking to a strategist recently, and he watches those sentiment readings very carefully, and he was kind of making the argument, Spencer, that they're over the top negative. That's how he put it. They're just over the top negative, and he obviously was kind of seeing it as a potential bullish contrarian indicator. I'm just curious, when you look at those sentiment readings, Spencer, you know, what do you make of them, and where do you see them potentially headed from here?
Look, Josh, let's consider the context. I mean, a lot of those crises were slow burns. You know, if you told someone that housing looks very dangerous and toppy in 2007, you had a few people listen to you. In 2008, a lot of people listened to you. But it's a crisis that unfolded over several months. Tech, the same thing, where things did look excessive in 99, late 99, early 2000. Then things started to sell off, but it took months to unfold. This has been compressed into such a tight time frame. In terms of, you know, things were fairly okay a week ago, and now things are very much not okay, that will tend to produce an extreme in sentiment as well. So, if you point to a specific measure, like you look at the AAII survey, which is going to come out tomorrow, that's the weekly survey that's run since 1987 of individual investors by that organization, you're likely to plumb a new all-time low. Does that mean that the outlook for stocks is at a new all-time high? The last time it was so low was at the very bottom, literally at the bottom of the great financial crisis bear market. I don't think so. I don't think you can equate that. It's not a one-for-one, because this has been so rapid and shocking that it's going to lead to greater extremes of sentiment.
And speaking of sentiment, Spencer, I also wanted to bring up something that we were talking with our markets reporter Josh Schaefer about in the break. Now, Josh is younger than us, and as he said, he and his friends, you know, they haven't really experienced a big drawdown in the markets. This would be their first and most dramatic, know, if they didn't really experience 2020, and that one was a quick one as well. So they have still been conditioned to buy the dip because it has mostly worked. Right? And so what kind of education does this provide, or what do they need to be educated on, sort of this new generation of investors who are now experiencing this really for the first time?
Yeah, it's an expensive tuition, Julie.
Yeah.
I think that even those, I mean, if you go back to 08, 09, and the percentage of people who are in the markets and the percentage of people who are professionally on Wall Street experiencing this, a majority did not live through that. And I think 2020 actually is something of a false example, right? You had the shortest bear market in history. You had the quickest recovery from a bear market in history. If you measure from the low point of the COVID bear market to 1 year after, 96% of U.S. stocks were higher, which is unprecedented. So picking a winning stock was like shooting fish in a barrel. And the stocks that rallied, by the way, off of that bottom were the junkiest stocks. The kind of you made the most money in unprofitable companies, SPACs, and things like that. So the lesson that it taught was an anti-lesson, if anything. And so, yeah, if this does, and I hope it doesn't, but if it turns into something more akin to a classic severe bear market like 08, 09, then no, this is going to come as a real education to them.
I'm curious, Spencer, just because we spoke to a very smart chartist early in the show today. And I, as a longtime market watcher yourself, I'm just curious, Spencer, how much faith and confidence do you yourself place in technicals when trying to at least call a bottom?
Mm-hmm. I personally do not. I mean, I'm not a chartist. I've never met a very wealthy chartist. So maybe that's my bias. I think charts are very interesting. What they describe is psychology. So, I mean, you can have, a support level and a resistance level, and those exist for a reason, but not because of lines on the chart, because a lot of stock was accumulated at a certain level and a lot of stock was sold at a certain level. And so what it's describing is investor psychology. And that's really what you have to get a grip on these days. That's what my column was about, was the sort of, you have these suckers rallies where you have a real extreme in sentiment, but it doesn't mean that you've hit the bottom. It just can be an interim bottom. You tend not to have a bottom. And first of all, we're not in a bear market yet, technically at all. But you tend, when you have a long, severe bear market, you tend to have a turning point when everyone is sick of stocks. No one wants to hear about stocks, like a March 09 moment, and that's when things finally turn around. And that's way ahead of us if we're heading into that kind of a a recession and severe bear market, you're months away at the very least from experiencing that.
What also strikes me about the recent market action, Spencer, is that usually when there is something that is dismaying the market, it dismays it less over time, even if it doesn't change. In other words, the tariff headlines, the market usually sort of adjusts and gets used to them. It doesn't seem to be happening in this particular case. Maybe because the tariff headlines are changing enough each time to trigger that new reaction. Do we get to that sort of habituation or pricing in, and how will we know when we've gotten there, I guess?
I'd be very rich if I knew when we get to that point. But I think that's your question is really apt. Is that there always is a habituation, even whether it's tariff headlines or a war or whatever, you get used to it. And the thing with stock markets is not only do you get habituated to a stream of bad, shocking news and crazy headlines and statements and social media declarations and things like that, but also prices get lower in the meantime. The lower the prices get, the more resilient they are. One issue that we're facing now is we started out at a very unusual, richly valued level for stocks when all this happened. This real period of American exceptionalism. You had record concentration on the Mag 7 in the stock market. They made up in excess of 30% of the S&P 500. Their valuations, you can slice it different ways, but they certainly weren't, rock bottom bargains. And you had this real belief that AI would make us all wealthy and transform the economy. And all of those things have taken hits. The lower that you get, and we're not at a cheap valuation by any means, historically speaking, but the cheaper the market gets, the less there's a kind of a burden to kind of show me how things turn around. And so, the ability to shock and valuation will eventually kind of lead things naturally to flatten out. And if you really get a headline saying, paused for 90 days or, or some kind of more sane level of tariffs on the rest of the world, then I think, we can have a very nice bounce. But the damage to the economy might already have been done. Let's not overlook that either. Even if you, kind of wind back the tape, you can't completely wind it back to where we were several days ago, because we've lost some trust, and companies are gun shy about making investments, buying inventory, sending shipments, things like that, with these constantly changing headlines that we could be right back here in a week.
Spencer, great to have you on the show today. Thanks so much for joining us.
Thanks.
President Trump's Liberation Day reciprocal tariff announcements have rocked markets and sparked broad fears about the prospect of a U.S. recession. But it turns out small business owners were feeling uncertain even before all that. Joining us now with more is Yahoo Finance's very own Danny Ramiro. Danny.
Small business confidence took a major hit in March. It fell to the lowest level since June of 2022. So according to the National Federation of Independent Business report, the Small Business Optimism Index fell over 3 points to 97.4. Now, it's important to note, like Josh said, that these results were before Trump announced its tariff plans. So this survey really gathers over 5,000 small business owners, their input across the country. And so people are feeling overwhelmed. The percentage of owners that anticipate better conditions over the next 6 months, that dropped 16 points. That was the biggest drop since December of 2020. And so some owners did report lower profits, and 35% of them blamed weaker sales, while 11% said that the drop really came from the increased cost of materials. Labor still remains a major challenge for small business owners. 40% of owners reported having a hard time filling positions, and only 12% of small business owners are planning to create new jobs in the next 3 months. But what's interesting from this report overall is that they don't mention the word tariffs at all. They just mention policy changes. So that was pretty interesting. And that has been over the consecutive months. We're not just saying this month. Last month, it was the same. They didn't mention tariffs at all, even though uncertainty is growing among the small business owners. So
maybe it's just a matter like their methodology. They just don't say the word. They just put it all under policy.
But it's under the same umbrella, right? And it means the same thing. Huh. So it was interesting to kind of see that follow, along this report. But yeah.
All right, we'll keep watching. Thank you, Danny. Appreciate it. Coming up, stocks tumbled in afternoon trading today and ended sharply lower. We're going to break down the top takeaways of the trading day. That's on the other side. Stick around. Much more market domination still to come. Stocks giving up gains to end the day lower as the S&P 500 nears a bear market. And Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
We began the day up almost 3%. At least we got there. And then we closed down about 2%, depending on what you're looking at. Is the momentum low in? And first, let me break that down. What is a momentum low? Well, we know what a price low is. That's when we get a low in price. But sometimes before that happens, before we get that price low, we get a momentum low. So the initial thrust down, you find a price in there, and sometimes you come back up. And you might go down a little bit farther, but that first thrust down is a momentum low. And that's what I'm trying to figure out if we have established yet. And for that, I'm looking at the S&P 500. And I've outlined these two potential forms of long-term support that have evolved here and that we just hit very recently, basically yesterday and today. This is a 6-year chart. So I'm going to take the pandemic low here and draw it through the 2022 bear market low. Guess where we landed yesterday? Now you take the intersection of that plus these market highs that we saw from late 2021, early 2022, the beginning of that bear market, and you see this convergence here. This would be a natural place, 4,800 or so, for price to stop, kind of recalibrate and see, well, maybe we're going to go higher again. But today kind of leaves that in doubt because we were not able to get a lot done. We almost fell into a bear market, and I'm just looking at the sector action, and I think this speaks volume. That's not the sector action. Here we go. This is what happened today. Lots of dark red, but over the last 4 days, that's just a lot of pressure. Is that going to be enough?
So bottom line, you don't think we even have the first momentum low here?
I think it's still in flux, and we need to take a look at the VIX, see how the VIX evolves. Right now, we got the VIX to the moon. And let's go back and let's chart what's happening there. Because just a few weeks ago, when we had a little bit less of a market scare, remember that? And the VIX went up to, say, 30 or so. The point that I was making at that time was it took a bit of time for that to happen. This is a year-to-date chart in the VIX. And because this is so high now, it's hard to see this action in here. This was basically up here before. These were fairly high levels. 30 in the VIX is not something you see every day. Now we're all the way up to 60, so it looks a lot less prominent here, but it took 2 weeks to get here. And my point about just kind of monitoring the VIX action is when you see the VIX going up like that and feeling comfortable staying at these elevated levels, that kind of tells you that there's a lot of risk to be hedged. As Steve Sosnick points out, the VIX is not a fear gauge. It is a proxy for institutional demand. And I actually had a chance to talk to Steve Sosnick about the VIX and what it actually represents the other day for Stocks in Translation. Here's what he had to say.
If you were really seriously freaked out by the way the market moved over the last couple of weeks, then you're probably carrying too much risk. But I think people started to embrace risk in the hopes of returns without embracing the good side of risk, but ignoring the downside of risk. If you made it through the last couple of weeks without sort of flipping out and just going, this stuff can happen, and you're young, and you don't need, you don't need the money for, say, college tuition or imminent retirement or something like that. Just stick to your guns, and you know what? Just keep putting money in your 401k, and that'll do far better for you in the long run.
So it just goes to show you there's some lessons to be learned here. And by the way, we taped that before this latest market meltdown. He was talking about the elevated risk we were seeing when that VIX went to 30. So it's all kind of relative here.
We talked stocks.
Yes.
Let's end here with what's going on in other markets. What are you looking at?
I'm looking at futures and crypto, and we're seeing a bit of pressure there. So let's start with the futures market, and I want to start with copper. Now, this is a one-day look. Here is a 4-day look at everything going on in futures. Not everything's in the red, ahead, but copper was just at a record high. It's HG equals F, down 6.5% over the last few days. Here's a year-to-date chart. So here is that all-time record high that we saw just 2 weeks ago. Within the last 3 days, it entered a bear market, and it is just down an incredible percentage here. That's a big move for something as big as copper. And remember, when it was at these highs, we had already had tariffs put on, so there's just been a big change in flavor and character as to this decline. Then we can take a look at gold. Gold took a bit of a tumble. It didn't get as heavily sold as some of the others. Here it is, over the 4 days, down 0.5%. It was at almost 3,200, dipped below 3,000, and it's recovered a bit. But my point is, sometimes when you see this heavy selling, even assets like gold, which are very high quality, those get thrown into it. It's a baby with the bathwater kind of effect there. I mentioned crypto, so I'm going to close on that. Let's take a look at what's happening with Bitcoin. Bitcoin down 8% over the last 4 days. This is a year-to-date chart. And you remember when we made this low in here, we were talking about that 200-day moving average as support, and I said,
what was the Jared Blickry target? Remind us.
I said 72,000, and guess what? We hit 74 yesterday. So why 72,000? Let's put a longer-term chart in. That's basically the lows that we had, or the highs that we had from 2024. There's some other technical stuff going on in there. We could sink below, but Bitcoin has held up the best, and so I think a quick trip down to 72 and then heading back up kind of flushes out the weak holders. That would be a nice bottom for me in crypto. Remains to be seen.
Thank you, buddy.
Thank you.
Appreciate it.
Let's talk eggs. Taking a look at Cal-Maine Foods, that egg producer reporting third quarter results, and the shares down about 3%. This is, in fact, the largest producer and distributor of fresh eggs in the United States. And the company coming out with numbers here that missed estimates, although there aren't many analysts who cover the company, so there aren't many estimates. But earnings per share coming out at $10.38. Net sales coming in just shy of what analysts had been anticipating here. Obviously, the company has been under pressure because of what we've been seeing in terms of avian flu. But in this statement, they talk a lot about the attempts to increase supply. Related to that, they talked about a 14% increase in the average number of layer hens during the quarter compared to the prior year. They talked about a 33% increase in the company's breeder flocks. And at the same time, Cal-Maine is doing two other things. They are approving a $500 million share buyback authorization. So that's something that is not helping the shares right now, but in theory could. And they're also diversifying out of the fresh egg business into the egg product business, buying a company called Echo Lake Foods for about $258 million. Echo Lake, a maker of ready-to-eat egg products and breakfast foods like waffles and frozen cooked omelets. So interesting move there as well. Obviously, there has been a lot of talk about eggs this year. And in the statement as well, the company's CEO, Sherman Miller, talks about the measures that the Trump administration has been taking to try to help the egg supply as well, and says they appreciate the current administration's announced plan to address volatility in the egg industry. Well, coming up, America's big three automakers, GM, Ford, and Stellantis, they're headed towards a bumpy ride. We'll have details, much more market domination overtime still to come.
America's big three automakers, GM, Ford, and Stellantis, headed toward a bumpy ride. A new report finding Detroit's big three to be the most exposed to President Trump's auto tariffs. And Yahoo Finance's senior reporter, Pras Subramanian, joins us now with more. Pras.
Yeah, I was a little surprised to see this information from JATO Dynamics talking about how it's actually the big three automakers from a point of view, from a global sales point of view, a high percentage of their automobiles are actually sold in the U.S. that are actually from imported areas, more so than the Japanese big three of Toyota, Honda, and Nissan, and also more so than the German big three of Volkswagen, BMW, and Mercedes. A number of reasons why, of course, U.S. automakers are more concentrated here with building. They're selling cars here. Inevitably, they sell more cars from import areas in the U.S. market. Whereas companies like Japan, Honda and Nissan, they build a lot of cars here too. They have a lot of factories here, and they have a broader global footprint of other markets, China, wherever else, more so than GM and Ford. Stellantis, they have a more of an international footprint, but still not so much as some of the other bigger guys, as you can see right there. Also, even the German automakers are 6.9% of total global sales are imports sold in the U.S., right? because they sell domestically in their own markets, but also internationally across a number of other markets, if that makes sense, right? So that's sort of what we're seeing. So it's ironic that we're seeing that the auto tariffs on foreign imports potentially hurting the big three more so than other large multinational, multi-country organizations.
Yeah, ironic.
Yeah.
And and of course these automakers, the CEOs have been somewhat the domestic automakers have been some of the most vocal folks who have reportedly tried to lobby the White House to get them to change, but to no avail.
Not yet. Yeah, no avail, not yet. I mean, look, you're talking about GM, plenty of factories in Mexico and Canada. They build a lot of their trucks in Mexico, actually. This is a big problem for them if they can't get that USMCA exemption in some sense from like a full amount of 25% to whatever, and they knock it down based on parts origination. So that's sort of the big picture, or the big question here is how can they adjust that and make it viable for them?
Yeah, it's a big question. All right, thanks, Pras. Affordability for cars was already an issue before President Trump's auto tariffs, and it's not just the vehicle itself. Approximately 60% of replacement parts are imported and subject to tariffs, adding even more pressure to the cost of ownership. For more, bringing in Nikhil Naikal, CEO at Kinetic. Kinetic is a company where you basically get an AI diagnostic of your vehicle to see what needs repairing here. And Nikhil, you guys do have facilities where people are bringing in their cars. And so what kind of effect do you expect to see as we see the tariffs push up prices on parts and on vehicles?
Hi, Julie. Thanks for having me. There is definitely going to be an impact here in the US because majority of new cars are going to see tariffs on them. And when things like that happen, the desire for Americans is to retain their existing cars, to repair their existing cars. And so the impact would be on the cost of repair and the ability to repair the cars quickly. And that's really where a lot of the focus at my company, at Kinetic, and companies that we work with, the emphasis is on how do we speed up the pace at which these cars can be repaired in an affordable way.
Nikhil, I'm curious, as a CEO, kind of a broader question, but all this drama, this volatility, this policy uncertainty, I'm just curious, you're running this company. Has it changed you? Has it kind of impacted how you think about running the business, expanding the business, Nikhil? Has it caused you to rethink how you want to spend, how you want to invest?
There's some impact of that, but the reality is at the scale that we are and the pace that we're growing with, remember that there's a big underlying backdrop of a labor shortage in this country, where even before coming into this administration, there was like close to 100,000 fewer auto technicians on an annual basis, right? So an emphasis for us has been how do we retool America and how do we retrain Americans, all while building a profitable business along the way. And that's really where the emphasis and focus has been for us. And we try to keep our heads down and just keep pushing forward with that mission.
I mean, sort of on that front, what's your biggest input cost? Are you guys, in other words, are you guys building facilities or are you retrofitting existing sort of, repair shops with your technology?
At this moment, we've been building our own, and we wanted to get the concept right? We wanted to, especially with the transition of cars going from being heavily mechanical component devices to electronic and digital devices, the repair is changing, and you need more precision in repair, you need more automation. And that's really where we felt having it vertically integrated gives us the ability to innovate quickly, gives us the ability to build new types of training programs. And we've really been seeing the benefits of that. For example, in our locations, we find that with our technology, with automation, we find that our technicians are moving twice as fast and they're scaling twice as fast compared to, traditionally. And so the idea would be to get the formula right. And we're always open-minded about scale and different forms of scalability, whether it is our own corporate-owned facilities or we work with other scaling partners with the technology being provided to them. So we're open-minded on these things as we scale.
Nikhil, always good to see you and to have you on the show. Thank you, sir.
Thank you. Appreciate it.
Stick around. Much more market domination still to come. With consumers feeling the effects of President Trump's tariffs, names in the travel space are also feeling the pressure. For more, we're going to welcome in now Chad Bynan, Senior Gaming, Lodging, and Theaters Analyst at Macquarie U.S. Equity Research. Chad, it's always good to see you on the show. So tariffs, front and center, Chad, worries about what it means for the U.S. economy, Chad, what it means for the global economy. I'm sure you're getting all kinds of questions from your clients. Ask you how this is going to ripple through your coverage universe. What are you telling them, Chad?
Sure. Thanks, Josh. Thanks for having me on today. So within our sector, I'd say most of our companies rely on the domestic consumer, and most of them have improved their balance sheets. They have pretty good free cash flow, low capex. So we think there's some really good value opportunities. Firstly, as we think about the lodging companies like Marriott, Hilton, Hyatt, these companies generate about 70% of their profits from North America. The calculus in terms of how they get to earnings growth, it's unit growth, that's mid-singles, and then it's rate increases, which is low singles, and that gets to a low double-digit earnings impact. Now, the biggest question now is what's going to happen with that consumer? The leisure consumer has been extremely strong since COVID. So that's going to be more of, an inflationary consumer sentiment type of issue. But from a tariff standpoint, we think that's going to impact a little bit of the construction build for these companies, but it's going to be a lower impact than what you're seeing with some of the other consumer companies, particularly retail and the others.
Chad, even though they get most of their revenue from North America, how much of that is incoming tourism from other countries who are coming to North America, or even cross-border travel? Because there's been a lot of reporting that overseas travel to the U.S. is down, that especially Canadian travel to the U.S. is down. So are there companies in your universe that are more and less exposed to that trend?
Yeah, it's a good question, Julie. I'd say long-haul international travel is a little bit under 5% for these companies. That's mainly business going into, New York, Los Angeles, San Francisco, Miami, and some of the bigger gateway cities. That hasn't fully recovered since COVID, so I don't think there's going to be a lot of lost business there. It's a really good question in terms of Canada and Mexico. And we're seeing that in Vegas. So looking at some of the Vegas numbers in February and from what we're hearing in March, Vegas derives about 11% of their visitation from international, and a little over half of that is from Canada and Mexico. And we are seeing declines there. So yeah, I'd say for the big hotel companies, mid-singles, and then as we look into other markets, whether it's going into Europe, going into Asia, I think that's going to be a low single digit impact. The business traveler at this point remains somewhat resilient, and that was something heading into 25 we were pretty excited about. You guys just talked about, that small business sentiment declining. That actually became more important than the big business for these hotel companies, which was a complete reversal versus what we saw 5 or 10 years ago. So that's something that we're definitely tracking at this time.
Chad, to the extent that the U.S. economy slows here, what is that going to mean potentially for the online sports betting companies, Chad? Flutter, DraftKings, which are two names I know you like.
Yeah, we really like it here. I mean, looking at the March Madness viewership and engagement for these companies, I think this is something that, if there's a stay-at-home trend, if there's a trade-down trend, I think some of these digital companies will grow revenues and profits kind of above where people are expecting. For the first quarter overall, I'd say volumes for digital gaming in the United States were up a little over 10%. So that's pretty consistent with what we saw in the fourth quarter. I think, the end of the football season and March Madness was pretty strong in terms of a customer acquisition standpoint. And then as we look through the rest of the year, these are companies where we don't think management teams will have to do anything with their guidance, with their outlook. I know that's a big focus as we head into earnings. Will companies pull guidance? Will they have to bring down guidance? For the digital companies, we feel very confident that they'll be able to maintain that. And then the other silver lining is state deficits could decline, and they will need some tax revenues. And generally, states like to lean on the gaming industry for tax revenues. That's historically when we've seen the most markets greenlit. So if we see iGaming as proposed in certain states, that could actually be a boon for companies like DraftKings and Flutter.
What about the physical casinos? I mean, I feel like there is sort of this old saw that, even in a recession, that gambling holds up, but I don't know if that's true. Chad, you tell me. And if the country does slip into recession, what that would mean for these companies.
It is. As we think about peak to trough revenues, the land-based gaming industry fell about 7% during the global financial crisis. Hotel industry fell about 14%. And then Vegas was the hardest on the land-based. That was about 18%. So the traditional land-based casinos that are in essentially 45 of the 50 states in the United States should be able to be fairly resistant. Your average customer is a 55 to 80-year-old woman. They're not going to be as affected as some of the other consumers at this market. They've accumulated a lot of wealth. They're generally a higher income type of customer. And again, it's kind of this staycation type of phenomenon. So it has been very resistant. And then in terms of profits, there were some labor increases in the past couple of years that made it difficult for these companies to improve margins, but we think they'll be able to hold in there. So there's lots of land-based free cash flow stocks that we really like here. Vegas will get hit a little bit harder than the average land-based casino, but we do think it will really hold in here. And worth noting is in the last 4 years, land-based operators have actually seen valuations come down. So there's been derating. They've underperformed against the S&P 4 years in a row. So this was our year, if we expected declining rates, for them to outperform. So we think if trends are more positive than the draconian situation, rates come down, this could be a nice little value basket to own.
Chad, always good to see you. Appreciate your time and those picks. Thank you.
Thank you. Appreciate it.
Time now for To Watch Wednesday, April 9th. We're going to start off on the tariff front. President Trump's reciprocal tariffs go into effect at midnight. Among those targeted is China, which is facing a steep 50% tariff in addition to 54% worth of tariffs, bringing the total to a 104% tariff on China.
Then there's earnings. We'll be getting some reporting from Delta and Constellation Brands tomorrow. Delta will announce results for the first quarter in the morning. It will be a key report for the airline industry. Remember, Delta slashed its earnings outlook last month on weaker U.S. demand.
And checking in on the Fed, some more Fed commentary coming tomorrow from Richmond Fed President Tom Barkin. This is coming after comments from San Francisco Fed President Mary Daly earlier today. Daly saying the Fed can take its time before making any adjustments to interest rates as it waits to see how trade policy plays out.
That's a wrap on today's Market Domination Overtime. Come back tomorrow at 3 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great night.